All right, and here comes the second session of today's Strategic Foresights on Future of Financial Services, co-host with Thai Bankers Associations and Payment System Office by Mr. Michael Araneta, Head of IDC Financial Insights Asia Pacific. Unfortunately, he wasn't able to join in today, but the session has already been recorded. Ladies and gentlemen, please welcome the session of Strategic Foresights on Future of Financial Services.
สวัสดีครับ My name is Michael. I represent IDC Financial Insights in the Asia Pacific region. It is a very interesting day today, especially as we are talking about how exactly Thai financial services would be part of this great digital era that we are expecting. Unfortunately, I've been traveling a lot, especially because this is the time of the year that we as analysts of IDC Financial Insights need to be on the ground speaking to the different decision makers across the region. I do not want to expose the audience to perhaps some COVID exposure that I also had in my recent trips, and therefore I'm making this recording. But this is also a very interesting time at IDC because exactly at this moment, on this Thursday, we are unveiling what we call the Futurescape series. This is a series of predictions that IDC would regularly come up with at this time of the year to talk about what happens in the future of not only financial services, but also in other industries, but also in different technology areas. So today, in this next 30 minutes, I will be sharing with you some of these reflections about the strategic foresights that we have used to come up with these predictions on the future of financial services. I will, of course, contextualize all of these predictions and all of these themes to the Thai market. Let's begin by a clear reflection that we started in this journey to be able to come up with these predictions. And our theory is that despite all the problems that we had over the past 2 years with COVID-19 and this epidemic type of banking, our capabilities to really serve our customers, to manage risks, and to be able to grow our respective businesses would have been better. And so in today's session, I will talk about some of the areas that we think there has been a great capability building among our respective institutions. The theory is that despite the lockdowns and despite all these disruptions that we saw over the past 2 years, we as financial institutions have gotten better. What are the areas that we have gotten better? In this first 2 areas, I will be talking about our great ability to scale. It has been a very interesting phenomenon to witness how more and more of our customers are moving to digital transactions. And this has been seen, evidenced, of course, by the experience over the past 2 years. Many of our customers have moved a lot of their transactions to the digital channels that we are maintaining. In 2020, we saw 50% a year-on-year growth in terms of digital transactions. And that was from a low base in 2019. But then in 2021, we saw 100% growth of digital transactions. This 100% continues well into 2022. And we also think that more growth will happen between now, 2023 and 2024. There is no stopping this growth of digital transactions. I'd also like to say that more of our institutions are going to manage this profusion of channels as well. We did a survey with different banks in the ASEAN region, and what we found out was that a typical bank now has to maintain 18 channels. Now, I know in Thailand, the branch channel is still very important. There was also an upsurge of the contact center channel, but very interesting that we have to maintain not just 5 or 6 channels, we have to maintain 18. This list of 18 channels is easy to come up with. You've got the mobile channels, channels that are specific to relationship manager, especially as we pursue wealth management. The point here is that it's not just really one channel where we build our strategies around, it is multiple channels. This is the era of omni-channel experience for our customers. Also very interesting that in 2021, what we saw was a declaration from DBS Bank in Singapore. And we also have to make a reference to DBS because they have been frequently cited as the most digital bank of all. According to their definition, any customer that transacts more than 75% of their total transactions, that means 75% of transactions over total, would be classified as a digital bank. And so this informs us that more and more organizations are now able to identify this 75 threshold, and so that they are able to differentiate their strategies between a non-digital customer and a fully digital customer. This is also very important for Thailand because we are starting to talk about the launch of these digital banks. These digital banks, regardless of whether they're affiliated with the traditional banks in the market, will really have to show this 75% threshold, and they need to be able to meet it on the first day of operations. And many of our institutions are now able to meet that 75% threshold, which leads me to say that maybe it does not necessarily mean that you have to launch a digital brand simply because you are probably a digital bank yourself at this point in time. I call your attention to the last bullet point in number 1, which is this Jevons paradox that we have made a reference to. In our reflections about the future of technology, we have looked at this economic concept called the Jevons paradox. Jevons paradox simply says that if the price of something, like say a commodity, goes down, the usage, the adoption of that particular something goes up, that you are not able to see the cost benefits in the end. This is, in fact, very clear in the digital transactions that we are seeing, because what we are witnessing is that the cost of digital transactions have gone down significantly, sometimes 10% of a branch channel, sometimes even less than 10%. The costs, let me say, per unit costs have actually gone down. This encourages more and more of our institutions to push digital channel transactions, but this also becomes easier and more cost-effective for our customers to deal with us via this digital channel. The output of all of these and the impact of all of these is that our customers are transacting more frequently with us. In fact, there are statistics coming from BOT that the number of transactions per customers have really increased significantly in a short period of time. And therefore, what we are seeing is this Jevons paradox at work, which means that although we are seeing the lower cost on a per unit basis per transaction, the number of transactions have actually increased, and therefore it's not necessarily cheaper to operate on digital. I'd also like to point you to the second phenomenon that we are witnessing, which is in a very short period of time, we are witnessing the launch or the adoption or the implementation of different types of interactions. Maybe this is supported by the banks, or maybe this comes as a surprise to the banks themselves, but we are witnessing at least 7 new types of interactions that are worth noting. I will not be able to go through this 7 in this short period of time that I have with you today. But let's begin first with the concept of pre-staged interactions. Now, pre-staged interactions are interesting because this allows the customer to set the time, the duration, the intention of interactions in advance. Think of somebody who says, I need to meet you at a particular branch to have this conversation about a wealth management or a mutual fund product, and I need to only have this 30-minute window with you. The implication here, is, especially if this number of pre-stage interactions increase, is that the data that our relationship managers, our frontline staff will need to have those very interesting conversations with their customers on a pre-stage interactions will have to be made ready accordingly. The other implication is that you do not need to have data all at one time in the branches or at the point of interaction. What you need is just-in-time data. There's also the concept of co-browsing. I think there has been a lot of improvements in the way that we show the same data and information to the customer so that we can visualize the data together, manipulate the data together, and make decisions on the data together as well. So data leads to decisions that can be made jointly. Many of these interactions are calling for information-heavy type of interactions. look at this. Staff are now oriented towards best actions and recommendations, and they need to have the appropriate recommendations to the customer that they are dealing with. These insights need to be based on real-time, in-context data about customers at the point of interaction. Recommendation-focused, escalation and multi-channel type of interactions where a transaction starts in a branch or online and then moves to a different channel. There are 18 channels, if you remember, and therefore you see this ability to escalate, maybe de-escalate, and then have this multi-channel strategy that allows data to move seamlessly from one channel to the next. The concept of returns as well, because this is very popular in the retail world. More and more of our customers are used to this retail concept of, if I don't like it, then I can have this ability to return a particular good or product or service. And you have to think about this because our customers are already thinking about this in their day-to-day lives. We have to think about our ability to let the customer change his or her mind, a concept that is, as I mentioned in this slide, filtering to financial services from customer experience in e-commerce. We have had a lot of conversations as well with regard to customer consent. And over the past 2 years, we have seen this come alive with the implementation of PDPA, where we are starting to look at the principles of customer consent. And this is based on the ability of our information to of the customer to be analyzed, but also based on informed consent, which means we tell the customer what we are doing with his or her data, and then we get the explicit consent coming back from the customer as well. Implication, data and analytics used to improve customer offers and customer recommendations need to be based on this consent mechanisms we have to set up in our respective institutions. Very interesting, because 3, 4, 5, and 6 in this next slide actually talks about how we gradually bring empowerment to our customers. There are a lot of new concepts with regard to customer engagement already, where we let the customer decide what choices about products or services he or she wants, the types of channels that he or she engages with. And then staff would rely on data, insights, and technology to make those decisions. But the principle is that the choice of the course of action will be given to the customer. We are not leading the customer. Rather, we are letting the customer lead us. There's also a very interesting phenomenon that we are witnessing, which is in number 4. And I talk about this as frictionless redefined. And over the past maybe 3 or maybe 4 years, even prior to the pandemic, we actually saw this rise of a lot of work around that of the customer journey redesign. We were scrambling to create the right onboarding experience, the right sales experience, the right fraud management experience that would impact the customer. But many of our strategies were actually based on this concept of we have to make business processes as frictionless as possible. In our studies, and this has been very interesting, the point of all these business process reengineering programs was actually the removal of doubt in the mind of our customer. And this is something that we saw in a bank in Hong Kong, and you can probably speculate which bank it is. But this bank started to think about customer journeys where you do not have doubt in the mind of the customer. There is certainty that the transaction is accurate, reliable, secure, safe, and fast for the customer. Think of it coming alive in some of the strategies for mobile applications that give sounds, for example, when a funds transfer has been made, making the customer feel more confident that that transaction was legitimate. There are other uses of this frictionless redefine in many of the customer journey, and I invite you to take a look at how you can really remove doubt in the mind of the customer, because doubt and the removal of such doubt is the point of all these customer journey designs that we are starting to implement. Again, the concept of trust, very important. And this is part of the Bank of Thailand strategy to make sure that our customers and the general public, the citizens of Thailand, the users of financial services, trust legitimate financial institutions. And how do we make sure that we have this trust all the time. One thing that we are looking at is high regard for customer information and security, privacy, and consent. We also need to look at some of the consent mechanisms to surface that in all our interactions, ethical use of AI, and this concept of conscientious financial services, very strong as a concept in Australia, where the regulators are starting to mandate that there should be no overselling of a product or a good or service coming from a bank, because this is part of the customer advocacy program where the customer should just be given the right recommendations when he or she needs it. Trust actually goes beyond just the concept of security and safety. It is about the ability of the financial institution to manifest right behavior for our customers. 6, instantaneous value. And I think that this has been an ongoing struggle for many of our institutions. But look at that. We've got the third highest number of transactions over the QR code payments. PromptPay has been a great success in the entire world, and we acknowledge that. And this is part of our ability to be able to deliver value instantaneously to our customer. We have to ensure real-time or near real-time response and delivery of products and services. In payments, real-time and security are the two most important factors for the adoption. And this is evidenced by how we have succeeded with PromptPay. And I also know that the PromptPay capabilities will be extended to the SME segment and the SME business. And I think that this is something to look forward to. How exactly are we going to manifest not only security, but this real-time concept to SME and small business transactions? The next slide actually talks about a divergence of our conversation where we identify what really matters the most for many financial institutions. And we also compare that with other business processes in other industries, retail, public sector, and manufacturing. In the retail sector, there are new concepts with regard to being able to have in-store collection and be able to collect the product or the good in 2 minutes. I was just in a retail store, a physical store this week, in fact, and yeah, 2 minutes in being able to do in-store collection. Obviously, this is part of this multi-channel escalation capabilities that we should be able to exhibit. In public sector, what matters the most is location intelligence, because we need to provide access to different citizens based on their location and their availability of products and services offered to them. So access and location, very important in the public sector. In manufacturing, order taking, order processing. But in banking, there are 8 business processes that matter the most in 2023. At the onset of 2023, onboarding, KYC, loan origination, bill payments, fraud escalation, report a lost cards. Number 7, credit payment reschedule. And number 8, event-based insurance payments. These are, apparently according to our research, the business processes that matter the most in 2023. Very interesting set of data coming from my colleagues at IDC. And then let's wrap up by talking about the concepts of collaborative engagement. And we talk about multi-channel escalation, but when we think about this, this becomes true to life when we do not have jarring or troublesome handoffs between the customer, as the customer even understands that multiple handoffs between units and staff and frontline people and devices will be needed to complete a process. A process in financial services is not happening in just one channel alone. It happens in multiple channels. What is very important, aside from removing friction or removing doubt, is the ability to remove the jarring handoffs between these parts and components of the business processes. Number 8, we've been talking about this for a long time, ecosystems-oriented interactions, where a bank has to work with different third parties, including the trusted third parties, payment services providers, similar to what we've been talking about in open banking. Of course, open APIs will be part of that strategy. But we know that not only does this extend to open banking, it also allows us to think about how we work with external and internal teams, how we ask them to collaborate together to add value in the value chain of financial services, where also internal teams coalesce and collaborate to deliver value all for the customer. Some examples here, I already talked about open banking and banking as a service. Very clear example of what we have defined as ecosystems-oriented interactions. But there's also fraud, ops, and risk, as well as customer advocacy. Very interesting stuff that we are seeing as part of this list of 8 that will shape financial services at the outset of 2023. But let me also talk about 2 other themes. These are 8 initially, but there are 2 themes that seem to be emerging very, very strongly. These are what we call the 2023 themes to watch out for. Let's acknowledge that there are new capabilities that we must be able to introduce to our organizations. I know that many of our audience today are part of the IT teams or the technology strategy teams, and this is a part of our survey of the same set of individuals in IT and technology strategy. Early in the year, we asked them, what are the 20 disciplines or what are the disciplines that you think you must be able to introduce to your organization? And this is not the most scientific survey. The number is not very clear, but there are consistent trends that have emerged from our surveys and our conversations. Number 1 to number 20, I won't go through them, obviously, but these are the frequently cited new disciplines that any financial institution must master at the outset of 2023. First is the ability to scale on demand to meet unpredictable uptake of digital services. I earlier talked about 100% growth. If it's 100% growth, then we must be able to provision for it. This is how cloud features in our strategies more and more, because they have cloud and the cloud services provider would have this ability or would help us scale on demand to meet unpredictable uptake of digital services. We know that's growing at 100%, but we also don't know how we will be able to reach that at different points in time through the year. There are obviously peaks and troughs in transactions, and we need to provision for that scale as well. New concepts of downtime and uptime. And number 2, we also are talking about instantaneous value, ensuring even faster speed of transactions without sacrificing security and reliability of transactions. That is in number 3. But if you really look at this list, the 20 here actually talks a lot about risk. I mean, let's talk about number 8, cloud migration risk. Number 9, cloud operations risk. We're also talking about risk governance. Risk seems to be part of our theme for 2023. And that's fair to say, because I think there are expectations of a downturn in various parts of the world. Our macroeconomic conditions, not necessarily ideal. We are really refocusing on risk. So one of the key themes that we are looking at in 2023, the return of risk. But risk has always been there. In this particular slide, I give you the 7 dimensions or sub-dimensions of risk traditionally defined by IDC. In theory, the more right you go, the more you shift towards information security, the more point solutions these are. And this is seen in the big spend areas of information security, technology spending, where you look at threat management, vulnerability management, some of the work that we had on web security, mobile security, and resiliency. Financial crimes, point solutions for KYC, CDD, AML, insurance claims fraud, and then credit risk, point solutions for different points in the value chain of lending. But now what we are seeing in 2023 is a shift towards the left, which means that watch out for this. We will return our focus on enterprise risk management and infrastructure, liquidity and asset liability management, market risk and trading. So what really will transpire in 2023 is the return to the left side of risk subsegments, especially in those solutions that need enterprise-wide abilities to integrate, orchestrate solutions, integrate data and orchestrate solutions, and then being able to respond as one enterprise to any risks that might emerge. Now, there are data, analytics, and tech implications for all of these. First, we start with reporting and compliance, IFRS as a key driver of investments. We also will be relying on new data, alternative data, to hone models already in place for credit decisioning, risk modeling, horizon scanning for risk model governance, so that we are able to develop, centralize, and deploy models and also hone the models as appropriate. This is the era of the return of risk. But there is also another big trend that we are tracking, which is that of sustainability. And many of our customers are thinking about sustainability in different ways. I mean, if you ask 100 institutions what their definition of sustainability, most likely you will get 100 different definitions as well. So at IDC Financial Insights, we say that the approach of many institutions with regard to sustainability comes in three areas. First, in sustainable banking operations. Secondly, in sustainable products, including the launch of all these digital lending that would become more green eventually, including some of the green bonds and so on, and the support of national goals to fund projects. And there is supposed to be a 5 trillion bill in terms of being able to support the UN SDGs. And banks and financial institutions have to be the conduits for capitals to support all of those SDG projects. It's $5 trillion every single year. As financial institutions, we have to stand by the world of sustainability. The other point that I'd like to state is that we came up with a list of 15 things that many financial institutions are supposed to be doing as sustainability emerges. These starts from green data centers down to the reporting on sustainability, down to the bottom left-hand side, creation of pathways for transition for key industries. Our work with regard to sustainability has only started as Thai financial services, but also as financial services in general. But what are the data analytics and tech implications here? We also will be looking at all the compliance and the regulatory mandates that we have to keep up with, especially for the listed institutions for reporting and compliance. We also will be relying on new data. Let's remember that there's a lot of data out there that gives us an indication of how sustainable we are or how sustainable our customers are. There are new types of data. They need to be real time and collected for long periods. So there will be implications to how we ingest data so that we are able to analyze them accordingly. Risk modeling with sustainability in mind, portfolio scenario analysis, especially as we move towards this sustainable products and services, particularly sustainable lending and model governance to develop, centralize, and deploy the new models covering climate risk. Very interesting stuff. I started with the 8 key trends that will shape 2023, but there are 2 big trends that will be quite long-lasting. This is the return of risk and the emergence of sustainability. But as I talk about these 2023 themes, and this is my last slide, there are some conclusions that I would say about how we should forecast all these trends that are emerging in the year to come. There will be new trends that will be shaped by customer adoption of digital. There will be new capabilities brought by the advancement of tech, and there will be integration of tech and business capabilities that will make us succeed. The point that I'm making here is that there are investments that you need to be made that you need to be making, but most of these investments have already been made. Look at analytics or your investments into data capabilities or customer data capabilities or your channels as well. All you need as you look at 2023 is to integrate them so that you are able to respond to the new customer dynamics of our time. Thank you very much. สวัสดีครับ
Thank you very much. And this is a very, very insightful presentation from Mr. Michael Araneta, Head of IDC Financial Insight Asia Pacific. Don't you agree that this is such a great foresight into what we can expect to see in the financial industry? Have you visited the first floor? Earlier, I mentioned the second floor, and actually the first floor, in the library, we have a lot of exhibitions and more than 60 booths as well. The stair stage on the first floor, interesting financial products from fintech firms, from banks, from non-banks, from government agencies, and also from consulting firms. So if you have time later today, please come and visit also the first floor and the second floor as well.